In this video, I'm going to give you a comprehensive understanding of market structure. We're going to talk about why market structure is important to every trader. So no matter your trading technique, your trading style, whether you trade price action, you trade smart money, you trade ITC, understanding market structure is the basic price action building block for every trader. So if you're going to become a successful trader, you need to understand market structure. I'm going to explain why. Then we're going to talk about how to identify market structure. So the easiest ways to identify market structure. And lastly, we're going to talk about how to take the best trades using market structure. So now let's get started. What exactly is market structure? So I'm going to be quick. Market structure is simply a price action technique that helps you determine the direction of the markets. So as a trader, when you open your chart, there are two things in mind, right? So you have two things in mind, two goals when you open your charts. The first is identify price levels where you could go long, or identify price levels where you could go short. So understanding market structure makes your life much easier as a trader because it helps you determine the direction of the market. And when you know the direction of the market, then you know the kind of trades and where to enter or exit your positions, right? So how do you identify market structures? So there are two ways to identify market structures, right? First is by zooming out a chart. So this is the go chart on the 1 hour time frame, right? And you can clearly see this chart looks bullish, right? So it shows that price is going to the upside, right? You can see all the way from these lows and to this high. So you can see price is clearly moving towards the upside. So when you see a chart like this by zooming out, just simply by zooming out, no technical analysis, nothing at all, you can clearly see that the price is in an uptrend, right? So the price is going up. So what you do is you look for opportunities to go long. You look for opportunities to open buy positions, right? So that doesn't mean you can take short positions within a bullish trend. We'll come to that later, right? But the point is, the first and the most easiest way to identify market structure is simply zooming out your charts. So when you zoom out a chart, you can clearly see the direction of the market. That gives you an insight as to the type of trades you want to take. So your first priority when you see a chart like this is to go long. Opportunities to go long. I don't mean just opening a chart and going long immediately, right? I mean looking for opportunities to go long. Now, let's take, for example, another chart. So this is a silver chart, for example. You can see simply by zooming out, you can tell that price is going up. You should be looking for opportunities to go long, not short. So opportunities to go long should be your primary objective when you see a chart like this. So similarly, another chart, for example, CHF-JPY, you can see clearly that this is trending upwards, right? The price is going higher. So this means you should be looking for opportunities to go up. So another one over here, USD CHF, what does this tell you? It tells you that the price is going down. So your primary objective when you open a chart like this should be looking for opportunities to go short, right? But most traders, when they open their charts, they just, anything the candle says, bam, they just want to go long, go short without understanding what the market is saying, right? So now the best and most effective way to identify market structure is by paying attention to swing highs and swing lows, right? So this illustration I just put on my chart is simply a the easiest, right, the most professional way to identify market structure. So swing highs and swing lows shows you that price is either going up or going low. So I'm going to explain. Right, so looking at this diagram, you can see we have high points and low points. So over here, right, so we have one high point here. This is known as a swing high. We have another swing high, then we have a swing low, another swing low. When you have a chart creating higher swing highs and higher swing lows, that is known as a bullish market structure, right? So this is very important because we're going to talk about change in market structure. So it's very important to understand this concept so that when we get to that part of the lesson, it's much easier for you, right? So when you see price creating higher highs and higher lows, so higher swing highs, right, and higher swing lows, this is known as a bullish market structure. And a bullish market structure simply means price is trending higher, price is going higher. So even if you get bearish pullbacks like this one over here, you get pullbacks like this, it's usually temporary, right? Temporary signifying that traders are likely taking profit from these levels because they mostly entered here, or they likely entered here or entered around these price levels. So the reason for this pullback is that Most traders tend to start taking profits to look for cheaper opportunities to buy those assets to, keep riding the trend as we go higher, right? That's the essence of a bullish market structure. Now, for a bearish market structure, I believe most traders know this, but I'm going to talk about it either way, right? You identify bearish market structure by watching out for lower swing highs and lower swing low. Basic price action, basic technical analysis, right? So we're going to get to the fun part very soon. So now, when you see price creating a lower swing high, lower swing low, it means the market is bearish, right? So there are more sellers in the market than buyers. So that's why you get massive price movements to the downside when you see a structure like this. So this is known as market structure, price action market structure. So no matter the type of trader you are, whether you're an ICT trader, smart money concept trader, pure price action trader, you must follow these principles of market structure because they are the basic foundational building blocks to building any successful trading strategy. Now there's what we call a ranging market, right? So ranging market, this is something I don't mess with, right? Because it simply tells you that the market is consolidating, right? So what this means is that we get equal highs, equal lows, right? Equal highs, equal lows, or close to or identical highs and lows. You can see over here, right? You can see the highs are identical, right? There's no clearly defined structure showing us that price is going higher. Price is just stored. So what this means is the price is consolidating. The price is having a hard time deciding where to head. You shouldn't be trading under the circumstances, right? You should be patient and waiting for the market to decide its direction before going long or short. But most traders want to, play the alternate movement, right? Go long at the support, go short at the resistance. It's risky, but we're going to explain why these are not the best trades to take if you want to build long-term success as a trader, right? So this is just the basics of how to identify market structure. Bullish market structure, you watch out for higher swing highs and higher swing low. So higher highs, higher lows give you lows, gives you a bullish market structure. Then lower highs, lower lows gives you a bearish market structure. Then equal highs, equal lows gives you a ranging market. You should be staying away from those charts, right? When you see a market like that. Now, how do we take trades using market structure, right? So going back to our example, I'm just going to clear this real quick. So going back to our example, this is a go chart on the 1 hour time frame. When you see a chart like this, price giving you clean and clear higher highs, right? You can see a higher swing high, another one here, another one here, another one here, and you can see higher lows, right? Higher lows. So this is a clear indication that the market is bullish. There are more bulls than the bears. Now, as a trader, when you identify your trend, right, you identify your structure. Structure shows you that the market is bullish. What else do? You look for opportunities to go to open trades in the direction of the trend. They always tell you the trend is your friend. Dude, that shit is real, all right? The trend is your friend, and you should follow the trend. Never trade against the trend if you want to be on the favorable side of the market. Now you can see we have this nasty price movement to the downside, right? For me, when you identify market structure like this, these pullbacks shouldn't be opportunities to go short. There should be opportunities to look for better opportunities to go long. But most traders want to take the risk of going short like this because they want to ride the reversal to the downside. But the truth is, you have no idea how low this will drop before we start going higher. But you do know that if you're able to time the bottom, which you can't do perfectly, right? But if you're able to get a good position around this low, you can clearly tell that price is likely going to break the next high, going higher, right? So it gives you a better risk to reward ratio in terms of the direction of the market when you decide to open your trades, rather than gambling and deciding to go short here, right? You can see if you're a trader, for example, and you decided to, let's say, take a trade here, aiming to go short for these lows, right? You can see your trade would have been short-lived, and you can see continuation of the move to the upside. So most traders make the mistake of wanting to catch this reversal movement to the downside, which isn't bad, but you will ruin your chances of even catching the best positions at the lows of the reversal. Now, personally, this is one of the ways I take my trades within, a structure after identifying the structure. Meanwhile, before we continue, everything I'm teaching right now is inside my complete trading system, right? different ways to trade the structures, using chart patterns, using moving averages, using Fibonacci retracements. I can cover all that in this video, but if you're interested in learning my complete trading system where I teach everything in this video and more in detail, use the link in the description below on the pinned comment, right? So moving on, in order for you to take trades in a market like this, all you need to do is look for possible areas of bounces. So you should be paying attention to your support AOVs, right? Support AOVs, that's one. I just identified one, right? We just identified another one over here, right? These are pockets of spaces you should be looking to take buy positions, right? You can see there's another one here. I think I made a reel with this last week if you saw that. So these are price levels where you should be looking to open positions to go long because the market is bullish. So when this thing comes down, right, if you are able to catch a trade within this area of support, this support AOV over here, you can see you tend to get tighter SL and you ride the trade as high as possible because you know the trend is still active, right? So another way to get into those positions will be watching out for breakouts in continuation of the trend. So trend continuation pattern, or BOS, right? Break of structure in the direction of the market, right? So I'm going to show you what that looks like. So instead of trading bounces, you want to trade breakouts, and that could mean taking, into account the price action or the chart patterns formed after we get those pullbacks, right? So you can see one over here. You can see we have another one over here like this, right? So this can even go in two ways, right? So this could be a descending triangle, the bullish breakout and retest, or this could be a simple area of resistance for a breakout, right? So the reason why breakout works well when you trade in line with the trend is because you are trading in the direction most buyers, most traders, most institutions want to trade. So when you see structures like this, the reason why most traders get faked out is because they are trying to sell. They're trying to catch quick sales. Why would you want to sell when the trend is bullish? So if you're trying to catch quick sales, you're going to get smoked. You rarely get fake outs. Rarely. I'm not saying it doesn't happen, right? But you rarely get fake outs if your breakout trades are in the direction of the trend, direction of the market structure, right? You can see another one over here, right? So this open with a gap. So this is gold. I'm going to show you other charts too, so you don't think it's just gold, right? That works like this. Looking at USD CHF, for example, the same thing here, right? Bearish market structure, price creating lower highs, right? Lower lows, lower swing highs, lower swing lows, right? Lower swing highs, lower swing lows. And now we just put in another lower low. And right now you can see a clean breakout. So this is what I'm talking about, right? So the best ways to take trades like this would be trying to pick out area of resistance, right? So area of resistance doesn't only apply to horizontal lines, right? So these trend lines you call trend lines can also be resistance level as long as they are drawn across the top of your swing highs. So you can see one high here, another high here. This is an area of resistance, right? So just because it's not flat horizontal, that doesn't mean it's not a resistance level. And you can see picking out a trade like this is just a no-brainer. So if you're patient enough, even if you go long here, you go short here, right? And your stop loss is placed above here, 62 pips, you can ride this trade for up to 200 pips. Risk to reward ratio tends to get higher. You tend to get more confidence with your trade because you're in line with the trend, and eventually the trend plays out as you expect. So the only time this doesn't work, or the disadvantage to this, is if you don't pay attention to possibilities of a trend reversal, then you may fall prey to taking trades when the trend is about to change. But I'm going to show you how to identify trend reversals as well, right? So this is just a no-brainer, right? So when you're able to identify trends, then it's easier to take trades. So these are the best trades to take if you want to, grow your account long-term as a trader, as a forex trader, stock trader, crypto trader. Pay attention to the trend. It's very, very important. Most traders don't do this. They just jump into trades, right? I'm going to show you a chart on Euro GBP. If you see a chart like this, right? So like this is 1 hour time frame, and most traders don't zoom out. And you see something like this, bro, you shouldn't be trading this shit, right? You shouldn't be struggling with this. You shouldn't be looking for a place to squeeze in a quick short position, a quick long position, because there's no clear trend here. But if you zoom out, it could give you a clear indication of what to take or the kind of trades to execute, right? So if you were paying attention to the movement over here, right, then this would probably be good opportunities to look for opportunities to go short, right? But the truth is some charts are cleaner than others, right? I'm going to show you another one now. So this is CHF-JPY, right? So CHF-JPY, clean bullish trend. Tell me why you want to go short in a market like this. Just one reason why. Leave your thoughts in the comment section below. Why would you want to go short in a market like this? You just don't, right? So this movement to the downside are simply opportunities where you are patient enough to get the best trade opportunities to go long in line with the trend. So you can see one over here. Clean retest, right? This is what we're talking about when we say area of values. So AOVs, right? You can see clean tap into this area of value, grabbing liquidity, and a bounce up. And this would have given you a very, very sleek stop loss, right? Stop loss of about 60 pips, take profit of about 400 or 350 pips. So that's a risk ratio of 1 to 6, 1 to 5. It's a no-brainer. This is what you should be watching out for. So even if you get one trade a week following trends, following market structure, you can go a month, 2 months, 3 months, even without a red or a loss. But your entries need to be timed perfectly, and those entries using candlestick reversals, using bounces of moving averages are being taught in my complete trading system. Use the link in the comment section to get those, right? But the thing is, for confirmations, you can simply trade breakouts, right? That's what I explained earlier. So you can do something like this. So if you're too scared to trade the bounce, you can see the moment we bounced off this area of resistance now turned support, you can see you simply go long. But your SL probably have to be wider, right, compared to trading the bounce. But damn it, it's still a decent opportunity. Risk to ratio of 1 to 2, 1 to 3, decent, right? So there are just so many opportunities where you could go long. So I'm just going to show you something real quick, right? So you pull up the moving average. So I use the 200 EMAs, 200 SMA as my area of support when I'm tracking trends. So for USD, CHF-JPY, I'm going to show you something really interesting. You can see 6 hours time frame, CHF-JPY, we've been trading above this trend line since May of 2025, right? Since April of 2025, we've been trading above this moving average. So 200 EMA, 200 SMA, my best moving average to track trends and follow trends. You can see each time we bounce off this moving average was the opportunity to go heavy, go all in, right? No, I'm a big fan of risk management, but you can see over here, nice bounce, support, boom, to the upside. Over here, you shouldn't be shorting. So the opportunity you get would be waiting for the price to come down, bounce off the moving average, boom, clean trade opportunities. You can see tight SL, massive upside. Another one here, boom, up. So even if you follow this trend, right, and you're able to catch 4 entries in a year, you could be making a banger, right? So this is a 6 hours time frame. You can go as low as the 4 hours time frame, right? If you want quicker trades, you can see over here, nice, over here, nice, over here, nice, then you failed here. But who cares if it fails once when you got 3 to 4 good solid trades, assuming you caught these trades, right? So that's just the point, right? Giving yourself enough room to, expand your ROR, right? Your risk to reward ratio. So if you are risking 1 to 3 on a trade, if you get 3 right and 1 wrong, who cares? You still be in the money, right? So that's the power of trading with trading in line with the trend using market structure. So now let's briefly talk about change in market structure, right? So change in market structure is simply a scenario where you get, a change in the formation of the price action that indicates a change in direction of the price movement, right? I'm going to show you with an illustration. So before we did something like this, right? So this is a bullish trend now turned into a bearish trend. So I'm going to show you real quick. So now you get something like this, right? You get something like this. Now, over here, you can see a clear formation of higher highs. Higher highs, so higher swing highs, and higher lows. So clearly, this is a bullish market structure. Now, a change in market structure is where the price action changes from creating higher swing highs and swing lows to creating lower swing highs and lower swing lows. So you can see that's what happened over here. So you can see 1, 2, 3, 4, right? So this over here is your change in the market structure from a bullish trend to a bearish trend, right? But the problem with this is most traders are not patient enough to confirm this change before they start taking trades, right? I'm going to show you what I mean. So most traders, right, when we take out this low by creating a lower low, they automatically assume the trend has changed, right? They go short here. They start looking for opportunity to go short. This is wrong because you have no idea if the market is going to do something like this. So I'm going to show you something really quick. The market could simply be creating something like this, right? A reversal pattern, right? So how do you know we are not getting a reversal pattern like this in continuation of the trend? So to reduce your chances of falling prey to this, you wait for price to create a lower high. So this high, right? So this new high has to be lower than this one, followed by a lower low. So by the time we take out this one again, then that's your confirmation that we are probably changing trend, and then you can look for opportunities to go short, right? But now this isn't to say it works like this all the time, and whenever you see this blah 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 and you're just in the money, right? It comes with its risk, but the point is you'll be better off reducing your losses following these patterns, following the trend, rather than just jumping into any trade that looks nice or looks right, like I explained with Euro GBP. So this is the reason why I don't struggle with ranging markets, right? So let's say, for example, you open your chart and you see something like this, right? So if you see something like this, maybe after zooming out, you shouldn't be struggling with this. You shouldn't be struggling with this, bro. You shouldn't be doing that, right? Because you're just going to get chopped off, right? Even if you risk a little, even if you risk $100 or $50 or $200 per trade, you're going to get chopped off. So that's why you wait, you ignore this chart completely, and you move on to cleaner chart. You can see CHF JPY, for example. You can check GBP JPY, right? GBP JPY as well. So JPY pairs have been trending nicely recently. So I'm just going to remove these twos, get rid of this moving average, and you can see trend is bullish. So this is a 4 hours chart on GBP JPY as well. You can see clean bullish trend now, right? So this is what we're talking about, market structure. So see, higher highs, higher lows over here, and now you can see there's a potential of us creating lower highs and lower lows. Now what do? Most traders would in fact start going short here because they feel, oh, we've created a lower high, a lower low, so there's a good chance this is a trend reversal. But that isn't the case. So the way you confirm will be waiting for price to create a lower low, reversal, then you look for opportunities to start going short, because then you now have a verified swing high, another lower high, a low, a lower low, another one, then an entry here confirms your opportunity to go short in line with this new formation, right? So another thing I use to confirm a change in trend, this is something I also teach in my course, right? My complete trading system. You can use the link in the comment section. We'll be using the moving averages again, right? So for now, let's see 6 hours chart, for example. Okay, now you can see this 6 hours chart doesn't align nicely with the moving average, right? So you go higher, find the perfect fix on your chart. So now you see on the 12 hours time frame, we have multiple touches. So this is GBP JPY different from CHF JPY. So you can see a bounce here, boom, up, a bounce here, boom, up, a bounce here, boom, up. So even if you think there's a change in trend here, you should be careful of the moving average, because there's a good chance this comes down here and just bounces off in continuation of the trend, because the moving average tracks the average price each trader, got into the market with, which keeps the trend alive. So at least another source of confirmation for me for trend reversal will be waiting for price to close below the moving average, retest the moving average as resistance, and fall down. This gives me a better confirmation of a trend reversal. So this is how I trade change in market structure, right? So there are different ways to confirm trend market structure. You can use Fibonacci tools, you can use chart pattern formation, you can use breakouts, but this is just one of the simplest, most sophisticated ways. I dive deeper into these things in my complete training system. If you want that, use the link in the description below. I am going to try as much as possible to put out more videos to help you learn how to trade for free. These things are simple. So these are just simple techniques nobody pay attention to, nobody talks about. Everybody wants to just get the holy grail of trading. But when it comes to carrying out market analysis to get the best trade opportunities, understanding market structure plays the most important roles, because it tells you the direction of the market, which then you are expected to follow the direction of the market to look for opportunities to open those trades in the direction of the market, in line with the trend, right? That's it briefly for this video. Just want to briefly show you how important it is to follow market structure. I know I probably didn't cover everything, so if there's something you think I didn't cover, you want to know about, leave them in the comment section down below, and I'll try as much as possible to maybe put out another video to help you figure things out, right? So once again, if you're interested in learning my complete trading system, I trade pure price action. Use the link in the pinned comment or in the description below. See you in the next one.